In less than 2 months, Google's stock price has fallen by over 20%. And while most of this downward move in Google's stock price has been caused by general weakness in the broader economy, more recently we have seen investors a little worried as the company announced that they are acquiring cloud security startup Wiz for $32 billion. So in today's video, we are going to take a look at Google's acquisition of Wiz, what that means for their cloud business moving forward, and how they could use this acquisition to position themselves to be more competitive in the market. And finally, we will also take a look at Google's valuation and what could change over the coming years and how that could impact Google's stock price. But before we get into all of that, I want to thank you all for the continued support on the channel. The best way you can support the channel is by simply dropping a like on this video. It helps get the video out there and more people seeing it. Thank you guys so much for watching. I hope you enjoy the rest of the video, and subscribe if you want to see more videos like this one. And one of the ways I try to give back to you guys is by being fully transparent about our portfolio and the moves that we are making in the market. This is the YouTube portfolio. It's currently sitting at a value of $59,930.71. We are actually down $6,000 in the last month. That has a lot to do with the moves that we have seen in the market. Again, the general weakness that we have seen overall, but it also has to do with Super Microcomputer and the move down we have seen in that company over the last month. However, if you zoom out a little bit, you can see what the upward trend is over the last 6 months. And so far in the last 6 months, we are up 15%, almost $8,000. And within this portfolio, we have $21,000 of it in individual stocks. Right now, that is up around 35%. We hold Alibaba, Google, Apple, Microsoft, Palantir, PayPal, SoFi, Super Microcomputer, and Visa. Our only position down is the one that we are going to be talking about today, and that is Google, down 3.4%. We currently have a market value of just under $2,800. And most recently, we have added to our position in Google and Microsoft, and then a couple months ago, we added Super Microcomputer to the portfolio. And then on top of that, we do hold 2 dividend ETFs, SCHD and VYM. They make up $30,000 worth of the portfolio, and both of them are very close to $15,000 in market value. They're up around 15% and 22% respectively. So today we are talking about a company that I do hold in my portfolio, so keep that in mind as we go through this video. Over the last 6 months, Google is basically flat, and even over the course of the last year, the stock has only traded up 10.27%. However, when you zoom out, Google is a very strong performer in the long term. Over the last 5 years, it has gone up over 200%. And recently, Google made a very interesting acquisition. They acquired cloud security startup company Wiz for $32 billion. This was an all-cash deal from Google, and they are expecting that the deal will close sometime in 2026. The company even released the following statement: Google Cloud is a leader in cloud infrastructure with deep AI expertise and a track record of industry-leading security innovation. Bringing all this to Wiz will help make their solutions even better and more scalable, benefiting customers and partners across all major clouds. This statement from Google is very interesting, especially the end of it where they say benefiting customers and partners across all major clouds. All major clouds. What they are talking about there is they are talking about staying on not only Google Cloud, but also offering their services across AWS and Azure by Microsoft. This is very important because at the end of the day, there are 2 things going on here. One, Google needs the FTC to actually approve this acquisition and say that it is okay to happen. That is one step. So they need to still offer their services across all clouds and not become exclusive only on Google. The second aspect of this, however, is that they can market their services across these other cloud-based services and potentially attract new customers into Google by offering certain maybe free services on Wiz to get customers in the door and using Google Cloud. And I think this statement is very much tailored for the FTC, because if we look a year ago, Google actually offered $23 billion to acquire Wiz, and Wiz ended up walking away from the deal because of investor concerns and antitrust lawsuits from the FTC on Google. Google. However, this time around, Wiz seems a lot more excited about this acquisition. Their CEO even released the following statement: "Becoming part of Google Cloud is effectively strapping a rocket to our backs. It will accelerate our rate of innovation faster than what we could achieve as a standalone company." However, I think it is a little bit difficult for Google to hide their true intentions, because at the end of the day, what Google is trying to do is they are trying to grow their cloud business. This market as of Q4 of 2024 was sitting at $91 billion and growing 22% year over year. Right now, Google is the number 3 player in this market behind Amazon Web Services and Microsoft's Azure. And there's a number of different ways that Google can use this acquisition of Wiz to expand their market share. A simple version of this would be offering Wiz for free to customers that are utilizing Google Cloud, and a paid version for customers that are utilizing Amazon Web Services or Microsoft Azure. And also keep in mind that all of these companies are building out their AI infrastructure on their cloud networks. So these cloud networks aren't going anywhere. In fact, they are growing incredibly fast, as seen by the 22% growth year over year. These customers are coming in and using their AI services on their cloud networks, and building out security systems like Google is doing is going to be very important, not only today, but into the future. And these are very important moves for Google to be making and executing upon very efficiently, because at the end of the day, if you look at Google's valuation, they are currently sitting at a forward P ratio of an 18.69. When you think about companies like Microsoft and Amazon, they are a lot more diversified than Google is. Google relies heavily on search, and if you look at the valuations of these other two companies, they are consistently trading in the 30s. That is the difference for Google compared to Microsoft, Amazon. A lot of these other companies, they have more diverse business models that aren't hit significantly in recessions. And that's why Google, if they're able to build out their cloud business, they could potentially trade at a much higher valuation. And this lower valuation isn't for a lack of growth. Google is expected to grow their EPS numbers by 11.7% in 2025, from $8.04 to $8.98. And then analysts even have that growth accelerating in 2026 to growth of 13.9% to $10.23 of EPS. If Google underperforms in 2025, analysts have them putting up $8.17 of EPS. That would result in a forward P ratio of a 20.20. In my opinion, Google should never trade at a 15 PE ratio. However, we have seen it trade there in the past, and if it were to trade there in the future, we could see the stock price trade down to $122 per share. The inline estimate from analysts is $8.98 of EPS. I honestly believe that Google should trade between a 25 to a 28 forward P ratio. However, we can look at a range anywhere from 20 to 28 in terms of their forward P, and that would result in a stock price anywhere from $179 per share to $251 per share. And in terms of outperformance, which Google has beat their EPS numbers each quarter for the last 4 quarters, analysts right now have $9.89 of EPS. That results in a forward P ratio of a 16.69. And again, I think Google could easily trade between a 20 and a 30 forward P ratio in this situation. That would be anywhere from $197 per share to almost $300 per share. When I look at Google, I think the biggest piece that they are missing is diversification of their numbers. They have strong top and bottom line growth. That is absolutely great. However, the problem is they are very reliant on their search business. If they're able to change that, I don't see why this company couldn't trade at a 30 forward PE. But keep in mind, that is all just my opinion. Don't buy a stock just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. And as always, guys, have a wonderful rest of your day. And for the joke of the day, how does the rancher keep track of his cattle? Check the comments down below for the answer. Thanks for watching.